Have you ever looked into getting a professional certificate to get a leg up in your career, but then you get to the price tag and wonder if it's really worth it? Well, today we are diving deep into a really common problem in the U.S. tax code. We're going to explore exactly why the tax breaks that are supposed to encourage education often leave modern learners like you completely out in the cold. Okay, let's jump right in. So, picture this. You did it. You invested in yourself with a pricey, high-value certificate from a great university. You spent thousands, maybe even tens of thousands of dollars, thinking, hey, at least I'll get a little help from Uncle Sam at tax time. But then, nothing. You file your taxes and get a big, fat zero back. It's a super frustrating and really common story, and we are about to break down exactly why it happens. And look, the stakes here are really, really high. The American Opportunity Tax Credit, you'll hear it called the AOTC, can be worth up to $2,500 per student per year. It is by far the most generous education credit out there. But as we're about to see, it's basically surrounded by a fortress of rules that locks out most of us who are trying to do any kind of continuing education. So here's our game plan for this deep dive. First, we're going to storm the AOTC's fortress and really understand its strict rules. Then, we'll look at how the schools themselves can actually be the barrier. After that, we'll check out a potential safety net, uncover a deduction that's been put on pause, and then wrap it all up with some real-world strategies you might actually be able to use. You know, the AOTC was really built with the traditional four-year college student in mind. So you have to think of its rules less like guidelines and more like a series of high, electrified walls. And to get this credit, you've got to clear every single one of them. Let's start with the tallest wall first. Okay, this slide right here gets to the absolute heart of the problem. The law, specifically Internal Revenue Code Section 25A B3, says the student has to be pursuing a degree or other recognized education credential. So what in the world does that actually mean? Well, the IRS and the Department of Education have an extremely narrow definition. It means the program itself has to be eligible for federal student aid, things like Pell Grants. Most professional certificates, even the expensive ones from big-name universities, are non-credit programs, so they're just not eligible. And just like that, you're out. That, my friends, is the trap. Next up, we've got the halftime rule. And this one really shows you the disconnect between these old rules and how people actually learn today. Section 25A 2B says a student has to be enrolled at least half-time. Now, for a traditional college kid, that's easy to measure. It's usually about 6 credit hours a semester. But what about a certificate program for a working professional? These often use things called continuing education units, or CEUs, or they're structured in these short, intense bursts. Well, those don't translate neatly into credit hours, so the school can't check the box saying you're half-time, and boom, you're disqualified again. This next barrier is just a hard stop. No way around it. Section 25A BB2C flat out limits the AOTC to only the first 4 years of post-secondary education. Now, think about who's taking these certificate programs. It's almost always professionals who already have a bachelor's degree. The moment you finish that degree, the tax code considers your first 4 years to be over and done with, and the door to the AOTC slams shut forever. It doesn't matter what you study next. And last, we've got this really strange and, frankly, punitive rule tucked away in Section 25A B2D. The AOTC is denied if the student has a prior felony drug conviction. What's so wild about this is that this restriction does not apply to the other big education credit, the lifetime learning credit. It's really just a leftover piece of old legislation that creates a massive hurdle for people trying to use education to get back on their feet. All right, so far, everything we've talked about has been about your eligibility as a student. But the rules are just as strict for the school itself. It's not enough to just go to a great school. In the eyes of the tax code, it has to be a very specific kind of school. And here it is, the core definition, straight out of Section 25AF2. An eligible educational institution is one that can participate in what are called Title IV federal student aid programs. This just means it has to be accredited and approved by the Department of Education to handle federal loans and grants. The tax code is basically saying, look, we'll only help you pay for education from these specific federally regulated schools. And this has some huge real-world consequences. Think about the modern skills economy. It's totally fueled by places like coding bootcamps, right? They can charge $20,000 and give you a direct path to a 6-figure job. But because most of them are independent, they aren't part of that Title IV system. So to the IRS, they're invisible. And the result? You get 0 tax credits for that massive tuition bill. It's a paradox. Okay, so if the AOTC is pretty much a non-starter, what's left? Well, the tax code does offer a fallback plan. It's called the Lifetime Learning Credit, or the LLC. It was designed to be more flexible, but as we're about to see, it's a much weaker safety net. This side-by-side comparison really lays it all out. You can see the LLC is way more flexible. No degree requirement, no workload rule, no 4-year limit. It's perfect for courses that acquire or improve job skills. But just look at the money side. The max credit is lower at $2,000. It's non-refundable, which means it can only zero out your tax bill. You don't get any back. And here's the real kicker. It's capped per tax return, not per student. So if you and your spouse are both taking classes to improve your careers, you still only get that one single credit. And if that wasn't enough, here's another huge hurdle, your income. For 2025, if you're married and filing a joint return, both credits start to phase out once your modified adjusted gross income hits $160,000, and they disappear completely at $180,000. For single folks, that window is even smaller, $80,000 to $90,000. So a lot of the mid-career professionals who need this retraining the most, well, they earn too much to qualify for any credit at all. So before 2018, there was actually another way to get a tax break. If the credits didn't work out, employees could often deduct their education costs as an unreimbursed business expense. But a major law change a few years back basically put that whole strategy on ice for most people. This timeline shows you exactly what happened. The Tax Cuts and Jobs Act of 2017, or TCJA, introduced a new rule, IRC 67G. And this new rule suspended all miscellaneous itemized deductions. That bucket included a whole bunch of things, including work-related education for anyone who's a W-2 employee. Now, the good news, if you can call it that, is that this suspension is temporary. It's set to expire after 2025. But for right now, that federal deduction is completely off the table. But, and this is a key strategy a lot of people miss, while the federal deduction is gone, not all states play by that rule. Some states, like California and New York, have decoupled from the specific part of the TCJA. And what that means is, if you live in one of those states, you can still deduct qualifying work-related education expenses on your state tax return. It won't help with your federal bill, but it can still provide some really valuable tax relief. So with all these complex rules, all these traps and loopholes, what can you actually do? Let's try to pull all this together into some clear, actionable advice for navigating this incredibly tricky landscape. Okay, first things first. Since many of these certificate programs won't send you the standard tax form, the Form 1098-T, the burden of proof is completely on you. So to successfully claim the Lifetime Learning Credit, you need to build a rock-solid case for the IRS. That means keep everything. Proof of payment, like your bank statements. Keep the course syllabus to prove it was actually from improving job skills. Go to the Department of Education's website, find the school, and take a screenshot showing it's a Title IV institution. And ask the school for an official tuition statement. You basically have to create your own bulletproof paper trail. You know, it turns out that sometimes the most powerful tool isn't a credit or a deduction at all. Under Internal Revenue Code Section 127, your employer can give you up to $5,250 a year in tax-free educational assistance. This benefit is amazing because it's so flexible. It can often be used for non-Title IV providers, like those coding bootcamps we talked about. This is almost always the best first place to look. Talk to your employer. So let's wrap this all up. This table right here is basically your cheat sheet for 2025. For certificate programs, the AOTC is almost always a no-go. The LLC is your main option, but you're limited by your income and the school's status. The federal deduction for employees? Suspended. But don't forget to check your state's rules. And the gold standard, if you can get it, is that employer assistance under Section 127. And that brings us right back to where we started. This continuing ed trap isn't a mistake. It's a structural feature of a tax code that was really designed for a different time. It creates this huge gap between the skills our economy is screaming for and the educational paths our laws actually support. And the big question we're left with is, how long can that disconnect possibly last?